Ed Smith, thank you for joining me today on the Finimize Podcast. Welcome.
Oh, it's my pleasure. Thank you.
So we're going to spend some time today on Rathbones, where you work, on your career, and on how you think about investing. But there is a lot going on in markets right now, so we've got to start there. The world's investors, by and large, are still dancing to the macroeconomic beat set by major central banks. We've had the Federal Reserve in the US just last month raise interest rates to the highest in 22 years, and there might be another hike to come. The ECB just hiked its key rate to its highest since 2001. Even the Bank of Japan has gotten into the action with some tweaks to its own policy. And just last week, first thing in August, the Bank of England hiked rates to their highest level in 15 years. So the big question is, what are you expecting, I guess, particularly for the Bank of England going forward? And are we finally near the end of this interest rate hiking cycle?
Okay, so I think as the Finimize article on the latest UK rate decision pointed out, there was a pretty significant development in the bank's statement last week. The bank said for the first time that it sees the current stance as restrictive, and that, quote, the MPC would ensure that the bank rate was sufficiently restricted for sufficiently long to return inflation to target, or words to that effect. And I translate that as we are near the peak, but don't expect cuts to come through anytime soon. And the interest rate futures market is possibly wrong on both counts, certainly the latter. I think cuts are only likely to come through, in our opinion, if, or perhaps rather when, a significant recession becomes evident. But there is a risk that we are not near the peak. And I think the July crop of PMI surveys, the business confidence surveys, which was also released last week, did a good job of summing up the Bank of England's rather unique predicament. As in most countries, there was much less robust growth in the UK services sector. That was a universal theme. But where most countries' surveys showed at the same time easing cost pressures, in the UK gauge actually saw those measures tick up again. So we think that any overshoot in indicators of labour market tightness, service sector inflation, or wage inflation could be sufficient for further hikes. And there is most risk there in the UK compared to the rest of the world, where we do think banks are largely done.
Got you. So maybe taking a bit of a look at the rest of the world and maybe the US in particular, there it seems like the US might be on the way to delivering a bit of a soft landing as far as rates and recession goes. What do you think about the likelihood of that coming home?
It's definitely possible. And we've got a 25% probability on it when we do our scenario planning exercises behind our asset allocation frameworks. But our base case is a disinflationary recession.
That's 25% likelihood of a soft landing.
Of a soft landing, yeah, that's right. Which is not insignificant, but that's not our main estimates, which is a disinflationary recession. That's our base case. And the signals that we look at to help us forecast whether we are likely to enter a recession or not operate famously with long and variable lags. But there are no recession signals that are yet past their sell-by dates, if you like, past the time at which we can say for sure it's different this time. We're well within the past windows between signal and recession, whether we look at the yield curve, change in bond yields, inflation-adjusted money supply, bank lending standards, home affordability and other housing metrics, or profit margins. And bank lending standards are something I particularly look at, right? Because there's never been a soft landing when rates have surged like they have done, and bank lending standards have tightened significantly at the same time. And look, there's clearly been resilience in the economy, particularly the US economy this year. That's largely due to those excess savings still supporting consumption. But in real terms, in inflation-adjusted terms, those savings have pretty much run out for all but the richest American cohorts real savings are actually now below the pre-COVID trend. And then the other strength has been the resilient service sector and resilient jobs market. But these are always the final shoe to drop and always what recession deniers, if you like, if I can put it like that, point to on the eve of a recession.
Got you. So I guess from the $64,000 question is, from a timing point of view, when does the other shoe drop in the US?
Yeah, I mean, you're absolutely right. That is a crucial question. Yeah, we had initially started forecasting a recession within 12 months at the end of August last year. So we have had to sort of update our view, right? Because we don't think one is going to start in August. Now that those excess savings have powered consumption for a little longer than we anticipated. But yeah, we've kicked the tires relentlessly on this, and we now think that a recession is likely to start in the first half of next year. And so that means that as investors, yeah, we're continuing to invest in the sorts of quality companies that tend to do better at weathering the cyclical tumult as you go through the downturn in the business cycle. We're defensively positioned.
Got you. So with the US recession perhaps hitting next year, the UK still likely to raise rates, or at least not plateau them just yet. Maybe there's an argument for swinging back to the UK, and with a long enough time horizon, UK stocks could look attractive. Valuations are low in the UK. Dividend yields are relatively attractive. There's a potential for improved company fundamentals if and when the UK economy, starts to, pick up a bit of steam. I guess on the flip side, the UK has been a value trap for a very long time. So, I mean, do you see value in the UK right now in stocks? Is that, are you more attracted to government bonds at the moment? What's the opportunity set in the UK if that thinking is correct?
Yeah, so I mean, look, you're definitely right. It's difficult not to see value there, right? Even at the end of last year, when the UK market delivered some pretty stunning outperformance relative to the rest of the world, particularly the US, the gap between UK market valuations and the rest of the world was still near multi-decade wides. And it's widened even more again this year. Now, some people who perhaps aren't analysing these things too carefully just dismiss that gap as a function of the fact that the UK listed market doesn't have a tech sector or companies that are going to naturally command loftier valuations. Well, even if we neutralise sector differences, so to compare sort of apples with apples, the UK is still very cheap compared to the rest of the world, if you assume that sector composition is the same. Whereas doing this before 2016 meant that the valuation of the UK was pretty much identical to elsewhere. Similarly, if you carve up the market into cohorts differentiated by different long-term growth expectations, UK high-growth companies trade much more cheaply than global high growth companies, companies the consensus expects to deliver the same amount of growth. Now, in a world in which capital is fairly free to move around, this just defies logic over the long run, at least. And at some point, I think it will start to be arbitrage, especially as we think the pound is also undervalued over the long run across a variety of different valuation frameworks, even if we assume a continuation of the UK's bleak sort of post-Brexit economic performance. So there's definitely value there. Over the long term, we would be holding more in the UK than we perhaps otherwise would. But valuation is not a great market timing tool at all. In fact, it is not a market timing tool at all. So it doesn't necessarily influence our sort of tactical allocations today. But the UK is a relatively defensive market. It has higher weights to some of the sort of consumer staples, healthcare, utility sectors that tend to weather downturns well. So there are some cyclical reasons to like the UK at the moment as well.
Awesome. Ed, you survived your initial grilling. You've definitely established your credentials and your knowledge. And so we'll come back to a little bit on the opportunities that you're seeing a bit later on. But I wanted to spend a bit of time thinking about your approach to investment research and analysis. And often when we talk about investing, investment processes, the entire space, we get drawn into discussing stocks or, in recent years, alternatives like crypto, or whatever's in the headlines on a given day. And we don't talk nearly enough about asset allocation. And I know you're a master of it. So I'm hoping we can start to change that. Can you spend a bit of time maybe talking about, why asset allocation is so important, and crucially, how to do it well?
Well, according to many institutional investors, and particularly the consultants that make a living doing this, asset allocation accounts for 90% of portfolio
They would say that.
But yeah, and it's actually rubbish, right? It doesn't. It accounts for 90% of the variation of returns. And that's something entirely different, right? Like if one pension fund has a 50% allocation to equities and another has 90%, then of course that allocation decision is going to dominate the reason for the differences between their returns. Yes. But that's not the same as asset allocation driving the absolute return, right? And it's widely miscited by industry. There was an old study out years ago that found that a shocking 49 out of 50 citations of this fact in the 1990s by investors got this wrong.
For what it's worth,
and I don't think it's changed much. For what it's
worth, anecdotally, people are still getting it wrong. So,
yeah, I think that's right. You still hear that kicking around. Now, assessing how much of the absolute return comes from asset allocation is fraught with methodological challenges. But put crudely and without wanting to summarize a whole bunch of academic papers, it ranges from quite a bit to a lot, but not 90%. So, look, strategic asset allocation is important to deliver superior returns relative to risk. It's a big belief of ours at Rathbones. Tactical asset allocation, how you allocate around that strategic position, is really important in guarding against the aberrations of the business cycle. Now, we don't believe that anyone can time the market perfectly, particularly the sort of intra sort of cycle peaks and troughs. But recessions, we think, are forecastable, and leaning away from the market and especially higher risk stocks as we approach one, and the very worst weekly returns are experienced is hugely important, far more important than trying to capture the very largest weekly returns, actually. And you've got factor selection as well, which is seen as a part of modern asset allocation. This is really important. Now, what that means is that if you bring even a small number of individual stocks into a portfolio, what starts to dictate a lot of the return are different sources of systemic risk, or what we call risk factors. Now, these can be market beta, just sensitivity to the global equity market, or a stock size, or whether it's cheap or expensive, or whether it has high or low quality balance sheets. And these factors perform better or worse in different market conditions. And it's important to address that as part of asset allocation and investing in general. Now, you ask, how do I do this? Well, obviously, I've dedicated my career to trying to figure it out. I can't say I have figured it out entirely, but I still do my best every day. You need good quantitative analysis to get a toehold on an otherwise intractable problem of analysing so many moving parts. Then you need really good qualitative analysis to pick apart what any quant work isn't picking up on. I think a big thing for me is that some investors still proceed with this idea of mean reversion, that the idea that valuations or interest rates, they sort of revert to this sort of somehow divinely dictated average over time. I'm really skeptical of any sort of asset allocation or investment theory based on mean reversion. Things do change and therefore relationships change. But so that would be sort of my number one tip for how to avoid sort of doing it badly, that's
super.
A mix of quant and qual.
That's super helpful. On that mean reversion point, I in my previous career, I was an equity research analyst for far too long. And if you looked at consensus historically, if you took, just for argument's sake, let's call them best quality companies, right? Top quartile companies in terms of returns and sustainability of returns. And you consistently see that on a 3-5 year basis, you'd have 1 or 2 good years forecast by consensus and then a mean reversion to industry level growth. And time again, you can pick any 10, 20, 30, 40, 50 year period for those companies. Time and time again, consensus estimates would be revised up because those companies continue to deliver sustainable growth ahead of market, profitability ahead of the industry, and so on. And consensus is always playing catch up. And so, to be a good analyst, on the one hand, there's loads of very clever things that we do, but simply not mean reverting a high quality company it felt like half the job at some point.
Yeah, that's very interesting. Yeah. And explain some of those sort of otherwise difficult to explain returns to these high quality companies, which shouldn't deliver over the long run an excess return, right? Because everyone should have figured it out.
Right, exactly. So we've talked about tips. That was really helpful. I'm going to spend a little bit of time on ESG. I think it's fair to say it's gained a lot of popularity in the last few years. I think that popularity has maybe waned a little bit through 2022 and into this year, and then there's been some pushback around greenwashing, which certainly is sort of I was going to say muddied the water, but maybe stirred the soup is a fairer description. How does Rathbones think about ESG within its investment approach?
So we do and are integrating ESG analysis into our entire investment process, because our reading of the literature is that holding all other things equal, how well a firm addresses its corporate social responsibility insofar as it pertains to material aspects of its business model, and I think that's a hugely important caveat, is associated with improved shareholder returns and greater profitability. And there's a lot of not so great analysis around this that tries to poo-poo that idea, but the really sort of thoughtful, dispassionate analyses that sort of appear in the peer-reviewed journals that treat ESG or CSR simply as a risk factor among many risk factors that can drive returns, I think are pretty persuasive that there are some excess returns to it. So we use the Sustainability Accounting Standards Board's, the SASB definitions to define what aspects are material to different sectors, different industries, and then use a combination of off-the-shelf and proprietary data to rank stocks within their sectors. And that helps inform our overall financial recommendations. It's another lens to predicting the sort of material outcomes of a company. Now, it's really important, I think, to understand what we're trying to achieve with this analysis, though. We're simply trying to minimize financial risks and maximize financial returns. Most of our clients, right, don't pay us to be altruistic with their money. And this isn't necessarily going to make the world a better place. And I don't know if you saw a research paper from Scientific Beta that gained a little bit of press this week, or maybe a couple of weeks ago. They found that there's no correlation between a firm's carbon emissions and its ESG score, or even just its E score. It's just its environmental score.
Okay.
Right? And that's, exactly. Kind of like, well, what's the point of all this? But that doesn't actually surprise us. I think if clients do have more altruistic goals, if they do want to sort of make some money, but also make the world a better place, we have a fantastic pioneering arm at Rathbones called Rathbone Greenbank Investments, who've been doing that sort of thing since the 2000s. But for our general investment process, ESG is about guarding against material financial risks and trying to capture financial opportunities, rather than just sort of ESG for ESG's sake.
I mean, that sounds like a dispassionate and pragmatic approach, which, if I think about Rathbones' history dating back to 1742, being dispassionate and pragmatic is probably what's led to the company being almost 300 years old. So I guess with that segue, could you spend a bit of time just to level set everyone who's listening, explaining, what is Rathbones? What do you guys do? And how are you different from your competitors?
So Rathbones is largely a discretionary investment manager in the wealth management sector. So largely looking after private client, trust, and charitable money. We've got a unit trust, a fund management arm as well, but the bulk of our business is discretionary wealth management. We've in the news, it's just been announced that we've got regulatory approval to acquire Investec. Investec's equivalent arm. So after that, we'll be managing around about £100 billion worth of assets under management, which will make us the UK's leading sort of independent discretionary investment manager, the largest.
Fantastic.
So most of our clients are in multi-asset portfolio. Most of our clients are retail clients, so it tends to be long only investments, not using exotic instruments for the most part. Most of our clients are long-term investors. In fact, a lot of our clients, on the charitable side, are endowments, so have indefinite time horizons, and often we manage money for families. So intergenerationally, needs to be trying to be intergenerationally unbiased. So that sort of means that we can afford to take a longer term view whilst trying to guard against the sort of short term risks.
Amazing. A lot in there to unpack. Okay, dealer's choice. Shall we spend a bit of time on the industry, or shall I come back to the follow-ups on this and spend a bit of time on your career?
We can talk a bit about the industry.
Okay, so I guess the first thing that jumps to mind with the Investec sort of deal is, you're going from a 60-odd billion assets under management, supervision, advisement number up to 100 billion once you sort of sign on the dotted line, as it were.
Yeah.
It feels to me that scale is really important in this industry. It feels like it's increasingly important. If we go back even 10, 15 years ago, there were more investment banks and wealth managers than you could shake a stick at. And those numbers are consolidating over time. I guess, on the one hand, what makes scale so important in the industry right now? And what are the other big levers in terms of competitive advantage that set you up, for the next 5, 10, 15 years?
So, I think we definitely do operate in a sector where the benefits of scale, and particularly technology or the deployment of technology, which goes hand in hand with scale, are becoming increasingly important. Whether that's technology to deliver the best client experiences, the best client reporting, or technology to deliver great financial planning services, or more in my wheelhouse, technology to enable our analysts and our investment managers to make better investment decisions and to make them and communicate them and put them together in cogent portfolios in the most efficient manner. And scale, obviously, and tech, as I said, go hand in hand, because these things cost a lot of money up front. So I think that's the biggest advantage to scale, and why the industry has moved in that direction. Thinking ahead, we are making this sort of acquisition so that we have the scale, in part, to deliver more innovation in how we access certain types of investment and the prices we pay for them, and to continue to be able to offer the kind of bespoke and personal services around that investment management that some of our peers have or will have to move away from in order to maintain margins.
Got you. And I guess one element, and tell me if you think differently here, but just from the outside looking in, talent is increasingly, a battlefield in terms of, everyone's making the same or similar promises to clients, which isn't to say that you're promising them the world, but you are promising to deliver us or to aim for a certain amount of performance over a period of time. And I guess, there's, on the one hand, there's fee pressure. On the other hand, there's, a war for talent to actually to deliver that performance, to do the analysis that you've spoken about, and so on. And what's that landscape like for you at the moment?
Yeah, I think there does seem to be a sort of talent shortage relative to demand at the moment in the industry. So again, having sort of scale in order to be able to invest in talent and then leverage that across a broader sort of client base, revenue base is really important. And we've also got to sort of think about how, if you go back sort of 20 years, a lot of the brightest minds wanted to go into finance, right? Because they saw that as exciting and a good way to make money. I mean, a lot of the less than brightest minds also wanted to go into finance, but it did attract some pretty bright people as well. Yeah, maybe me too. But I don't think that really is the case today. Actually, a lot of people want to go into sort of solving some of the world's sort of bigger problems in sort of green technology or engineering, or going into artificial intelligence and the sort of cutting edge of data science and computer engineering. So I think our industry needs to try and get some of that talent back, actually. And again, I think it's sort of being able to operate at a scale where you can start to set up sort of innovation labs and operate with a sort of real forward-looking sort of technology-first approach is perhaps a way to do that.
I'd also argue that's going to be super important for you mentioned intergenerational sort of management, and as Gen X's and millennials start to inherit billions and billions in aggregate over the next 20 odd years, how they engage with their financial services providers has already changed, and they're not all of a sudden necessarily going to want the same things as their parents and grandparents before them.
Absolutely right. Yeah, and that intergenerational transfer, it's been spoken about for a long while, right? But it hasn't really come through because baby boomers have just been too young. Baby boomers are now starting to turn 80, right? So, for sort of actuarial reasons alone, that is going to start to happen much more. And as you say, like, people who've grown up sort of with banking apps, from the challenger banks, and doing their shopping online and sort of getting, various sort of bits of information, online, they're going to demand something different.
Okay, fantastic. Shifting gears a little bit. So you are co-chief investment officer of Rathbones. You came into the role in July 2021, but let's rewind a bit. We talked about both of us maybe stumbling into the industry. My undergrad was genetics. Yours was history, I believe, or modern history. So doesn't suggest you were necessarily a CIO in the making back at university. So, can you maybe talk a little bit about your path and how you got into the seat you're in today?
Yeah, sure. I did study modern history as an undergrad degree, but at a university that allowed for a multidisciplinary approach in there. So I put quite a bit of economics and the study of socio-economic change into that degree. And then I joined BlackRock's graduate scheme, but actually in an account management role, sort of largely focused on liability-driven investing for pension funds, which actually came in pretty handy last year, right, during the Liz Truss debacle. And And after a short while, I realised I wanted a more research-oriented role. So I left to start a career as an investment strategist and economist. Lastly, I completed the CFA, the Chartered Financial Analyst exams, and I did a postgraduate degree part-time, a Master of Science in economic history from the London School of Economics, which is really the study of long-run empirical economics, both econometrically and qualitatively, which really sort of gives you, sort of hone the tools that I think are pretty analogous to what we do.
Is that the I might be wrong here. Is that the degree from which the quote comes? In the long run, we're all dead, sort of thing.
Yeah, well, that's certainly part of it. Yeah, that's right. That's sort of Keynes' quote. Yeah, but it also sort of helps you sort of analyse the short run, which can be more useful. And I really can't recommend that degree highly enough, actually, for anyone involved in asset allocation or top-down investment strategy.
Awesome. So one of the things that I know you're proud of having done, because I stalked you on the internet before this podcast, is launching a bunch of initiatives to improve the frequency, the content, and the usefulness of your client comms, client communications. And there's some fantastic survey data showing that you've helped improve those external comms. People rate it highly. So as a head of content, firstly, fantastic stats, well done. But from my point of view, and also from Finimize, we produce content. I'd love to hear more about how you did that.
So really, it's just about doing more with what we have already. I think so. So most of our comms now come in a number of different formats to suit people with different appetites, different time constraints, and so on. So take the usual sort of quarterly investment outlook. All firms like ours produce one. Now we produce, we now do it in many different ways. So we produce a more technical sort of 3-page version for those who want some pretty dense detail. We also distill it down into a less than 1 page of bullet points written for people with virtually no technical knowledge of finance or economics, but they still want to sort of hear what we want to say. We produce a short video that sits somewhere in between the two that people who prefer to watch video like, and we host a webinar around it so clients can ask us questions directly about things that we don't go into. So it's really about doing more with what you have to make sure you're reaching all of the different types of personas that might actually want to listen to believe it or not, to what I have to say.
Fantastic. My boss will be happy to hear doing more with what you've got as the answer. When they go in here and say, well, look, this is what Rathbones is doing. Can we do that too? Okay, so coming back to markets for a little while, we've obviously gone from a low rate environment through the 2010s to a higher rate. I wouldn't necessarily say high rate, but higher rate environment in the last couple of years. Maybe this is an obvious question, but how has the conversation changed, both with the clients you're having externally, but also with the investment teams internally?
So I think certainly the second half of the 2010s, the second half of that low rate, zero rate environment, was really dominated by the outperformance of so-called growth stocks relative to value stocks. Now, we think that those years, which just about extended into the 2020s, the first couple of years, were exceptional. We're all human, we all have an innate tendency to think the recent past is the norm, but actually if you check the sort of very long-term data, so over the last 90 years, it is rare for highly valued stocks to outperform cheaper ones. And 90 years covers a lot of different macroeconomic environments, right? And the dot-com bubble aside, the only other period where we see sustained outperformance of expensive growth stocks was the 1930s. Okay. And what do the 30s and the 2010s have in common? Well, they came after a hugely disinflationary financial crisis, right? And that's not where we are today. However we sort of get out of the recent episode, I don't think we're going to have a hugely disinflationary financial crisis. I think slightly higher, definitely more volatile inflation and interest rates is where we are. So the conversation becomes sort of much sort of less about these sort of really quite sort of simple macroeconomic sort of characteristics, and that it basically meant you could just overweight the Nasdaq and kick back and watch the sort of outperformance come in. So okay, well, how do we outperform now things have changed? It's about doing a lot more work, I think, to generate decent returns, which is what it always used to be about. So sort of we're thinking about who might the sort of winners and losers sort of be as sort of new technologies come about and perhaps sort of diffuse more widely than the sort of few sort of mega cap sort of platform companies that have dominated markets in the 2010s.
Got you. So maybe if I drill down a little bit into that, and with the context of your third quarter outlook, one of the themes that you talk about in there is AI, and depending on how you measure it, AI is basically driven all the US stock market's gain this year. And you've talked about the platform companies, the Microsofts that have benefited this year, the Nvidia, which is up 220% so far this year. Interestingly, when we surveyed our members this quarter, a third of them said that investing in AI is overhyped. So where do you sit on that spectrum right now? How are you looking to play the space? You've given a bit of a clue there in terms of long-term winners, but outside the platform names, what's the approach there?
Yeah, I think I definitely sympathise with that 30%. Would I characterise it as that? Probably not. Some people are using the phrase bubble, right? And now I think there's some froth and perhaps some naivety about who the winners ultimately will be and when productivity improvements would come. But I don't think we're in a bubble, because bubbles tend to involve complete fantasy valuations, right? Based on enterprise value to clicks or these
the good old days.
Sort of, yeah, exactly. Or these are sort of dressed up.
EV to eyeballs. Yeah,
EV to eyeballs. That's another one, exactly. And sort of with a sort of fancier, drier name, people call this like total addressable market of arguments, but which it's all like quite sort of spivvy. But now the valuations of some of these mega cap tech AI related stocks have may now be very lofty, possibly unjustifiably so in some cases, but they're not pure fantasy, right? There's a lot of actual money being made and likely to be made underneath them. It's just a question of whether that's sort of being over extrapolated. But I think there is look, there are many questions still to be answered about generative AI, right? And I think that's the sort of bottom line. Like, if generative AI is a general purpose technology, it could conceivably boost GDP growth by sort of 1 to 2% a year, which you'll have seen like some of the sell-side investment banks say. But from when, right? When will that boost take effect? No one knows if it will be from next year, from 10 years' time, or more, right? A productivity boom tends to follow a period of supernormal investment spending, but will higher interest rates, high levels of indebtedness, high uncertainty around inflation constrain companies from making that necessary and governments from making that necessary investment spend? Will AI spread out some of the returns to technology that have been kept in firms with quasi-monopoly status lately? So if it leads to more competition, then actually stock market returns, or at least market cap weighted stock market returns might be lower,
Yeah.
right? Regulation, we don't know about that. Will negative social and economic side effects from generative AI sort of displacing some workers, at least in the short term, require more government spending? And will therefore governments tax the beneficiaries more? And so pre-tax profits might be great, but post-tax, they may not be so spectacular.
Yeah.
There are all of these questions that are still to answer. So look, investors have got to pay attention. We've got to start, I think you need to position yourself for it, but you need to take a diversified approach across the investment stack, from the chip makers to the architects and the hyperscalers like Microsoft, as well as those companies actually applying AI, which is relatively few at the moment. But on that note, we're exploring some sort of innovative ways to access diversified baskets there.
Fantastic. And then one other area was Japan, which has been getting a lot of attention from investors, not least Warren Buffett by way of Berkshire Hathaway, which has bought into a handful of trading companies out there. So, you guys are alive to the opportunity. What's got you and the team excited about Japan?
Yeah, so we've been overweight Japan. We've liked Japan for many years now, and some years that's been hard, but most years it's done relatively well for us. And Warren Buffett's definitely done us a favor this year, because we're seeing not just Mr. Buffett, but other foreign investment flows into China accelerate to levels we haven't seen for really quite some time. And there's a few reasons for that, which is great when there's sort of quite a number of reasons to point to, because it means if one doesn't quite work out, you've got other parts of your investment thesis to fall back on. So tactically, Japan is somewhat dislocated from the global cycle due to its unique monetary policy, that totally different context around inflation. And because it was the last to reopen from the pandemic compared to other developed economies, and so its economy still has some bounce back gains to be felt, and the return of Chinese tourists should help the economy as a whole. Turning to its companies, its stock market, it's a beneficiary of some structural forces that you don't get so much elsewhere in developed markets. So improving governance, and in turn valuation multiples on the back of some of the Tokyo Stock Exchange initiatives. And we're seeing return on equity ratios catching up with the developed market average. Like that's the sort of proof of that sort of reform pudding. And Japan looks really attractively priced, right? More than half of companies are net cash. That's no bad thing in a higher rate world when there's still some uncertainty around that. And Japanese buybacks are accelerating.
Okay, that's a multi-pronged thesis. Fantastic. Before I let you go, Ed, just a few lightning questions, if I may.
Go for it. Okay.
What was your very first investment?
My very first, personally, this is going to sound very arcane, but it was in a Palladium.
Oh.
Because, an ETF, Palladium ETF, for reasons I can't remember now, but at the time, in my young sort of 19-year-old mind, I thought it sounded like a good idea linked to some developments in the industrial cycle.
Okay, well, you dipped your toe in, that's what counts.
Exactly. It was a story to tell interviewers, right, at the time.
This might link to the first question. What's the worst investment you've made?
I don't think it was that, actually. I sold before it was too late. The worst investment. Look, there are also always cases where we get things wrong. At Rathbones, we try to get things right more often than we get things wrong, and that's sort of really the name of the game. You get 2/3 of your investment right, you will be top quartile, basically. So you can get a lot of things wrong, and sometimes we misjudge. Most commonly, the price at which you enter a really great investment story. That's the hardest thing to get right.
Which investor do you admire the most?
This is a boring answer, but it is Warren Buffett. And now we're very different investors,
Yeah.
right? Because I'm a top-down guy,
Yeah.
right? But so it may come as a surprise when I'm picking up a sort of classic bottom-up top stock picker who says top-down is irrelevant. It's because he's spent a whole career constantly learning, constantly being alert to the way that the world is changing, and applying that to a rigorous and sort of constant framework of investment analysis. So we come from different sides of the investment spectrum, but I really admire his constant education and his rigorous and strict investment process.
That's lovely. And last, what's the best piece of investment advice you could give to our listeners that you wish someone had given to you when you were younger?
Don't get swept up in momentum.
Ooh.
Or as we would call it these days, fear of missing out.
Bold.
Momentum is a powerful force. It matters. Going against momentum is not what you always want to do. But if you've got conviction in something that you are sure that you've arrived at through a rigorous process, if the market is going against you, don't get swept up and capitulate. Stick to your guns. If you get it wrong, at least you can justify why.
Nice. Ed, finally, where can people find out more about you, about Rathbones, and about the investment products and services you offer?
That's very kind. You can go to rathbones.com. We've got a recently rebranded website, so hopefully it looks lovely. And thank you. Good to have that endorsement. Rathbones.
Awesome. Ed Smith, co-CIO at Rathbones, thank you so much for joining us.
Oh, thank you.